Stocks, bonds, mutual funds, and index funds. What are they and what you need to know? There's no more powerful way to take control of your wealth than to learn what your options are. In these crazy days of cryptocurrency, NFTs, and day trading, it can feel confusing and frustrating. Why are these young kids making millions on a GameStop tip you knew nothing about? Why are celebrities like Eminem investing in digital art you've never even heard of? Yes, it's a wild, wild west world out there in the world of investing, trading, buying, and selling. The good news is, there are some very simple steps you can take to learning about finance and wealth, and there are some very simple steps you can take to growing your own wealth starting today. But before we get into that, please take a minute to hit the like button, subscribe to our channel, and turn on all notifications to make sure you don't miss a single update. Now let's jump right in. Unlike NFTs and crypto, and a lot of other crazy stuff that has only recently surfaced in finance, stocks, bonds, mutual funds, and index funds have been around forever. The good thing about that is we have a ton of history on them. The magic that all financial investors and advisors have, young and old, experienced and just out of the gate, is that they have decades of history to draw from, to make predictions on, and to advise their clients or themselves on, depending on what you're hoping to do with your money. And depending on how much risk you're willing to take, each of these types of investments can serve you well. So, what are they? Stocks. A stock is probably the most well-known of each of these types of investments. A stock represents a fraction of ownership in a company. The owner of the stock essentially owns shares of the company. And thus, when the company does well, it is profitable, the stock reflects that profitability by going up, and the stockholder's overall wealth also rises. Thus, units of stock are often referred to as shares. Typically, a corporation will go public, meaning they make stock in their company available to buy when they hope to raise capital for their business. As more people invest in the company is able to use those investments to expand and grow the business, making it more profitable and rewarding the stockholders for their investments. Stocks are bought and sold on stock exchanges, usually through a stockbroker, either online or through a brokerage firm, and they are the foundation of nearly every single financial portfolio. Historically, stocks outperform every other investment in the long run, mostly because of their strong reputation for being mostly predictable and reliable forms of investment. Note that owning stock or shares in a company does not make you an owner of that company. You're the shareholder. You have voting power, you get dividends, company profits, and you have the right to sell your shares to whomever you like. The downside to stocks is that, of course, there is no guarantee or insurance against total loss of wealth. If for some reason a company fails and goes bankrupt, you can lose everything. This potential loss is why it's critical to pay attention to the history of a company, of stocks, and to have a financial advisor with a strong reputation and experience giving you pointers. Bonds. A bond, unlike a stock, is a unit of debt. You don't own shares in a company when you buy a bond. You are lending the company or government money. Indeed, the most well-known form of bond is a government bond. The US government has issued bonds during difficult financial times to get its citizens invested in their country. War bonds were very common during both world wars. Bonds can be issued by companies, all forms of government, federal, state, and local, and it always includes the details of the payment upon it. You agree to how much you're willing to buy or invest, and the issuer agrees to how much they will pay you back, including the interest as well as the date of full repayment, known as the maturity date. Owners of bonds are debt holders or creditors. The pros of bonds are that you will not lose your money. They are fixed income security, and unless the company or government goes under, you will get your money back with interest. It is a secure type of investment. The downside is that the interest rate is not usually very high, and the maturity date is typically pretty far out. Note that the bonds with lower interest rates usually have longer maturity dates, and vice versa. Mutual funds. Mutual funds are a collection of stocks, bonds, and other assets. Investment firms form to package these mutual funds and employ money managers to operate the funds. These money managers will allocate the fund's assets and work to get those funds to earn money for the fund's investors. Mutual funds give investors an opportunity to pool funds with other investors and get involved with much larger, higher-priced assets they may not otherwise be able to afford. This opportunity also means they stand to gain where they otherwise would not. That is the benefit. Note that mutual funds are usually packaged in accordance with the factors that make them higher or lower risk, more or less stable, and expect to gain more or less interest in a longer or shorter period of time. A money manager can find a strong, stable fund to invest in for long-term wealth or a more risky, high-interest fund to grow wealth a bit more quickly. Mutual funds carry with them the same risks, exposure, and potential for gain and loss as stocks and other securities do. If the fund does well, you do well. If the fund does poorly, you could lose everything. Most employer retirement funds go into mutual funds, managed by an investment specialist that advises the company. Index funds. An index fund is a safer form of mutual fund. It is considered the ideal core portfolio holding for a retirement fund like 401k or an IRA, as it has a portfolio that is constructed to match the components of a financial market index, the most common being the S&P 500. Basically, an index fund is designed to mimic the best performing companies that are publicly traded today. And index funds offer investors the opportunity to buy into the most profitable corporations at very low cost with little fees and operating expenses. Warren Buffett, world-renowned investor and all-around good guy, has strongly recommended investment in index funds as a safe haven investment for the long term. The big downside to index funds would be the lack of flash, glitz, and glamour you might get from a higher risk, faster returning stock or mutual fund. Which one is right for you? So, how do you decide where to start? It really depends on what your goals are. You can play it safe with index funds and bonds and count on long-term growth. If you're getting into day trading, you can experiment with stocks. If you're working with a money manager, you can explore the best mutual funds for your needs. And you can mix and match. Don't think that you're tied down to only one choice. You're definitely not. The world of finance is big and bold and beautiful, and you would do well to remember that you will learn the most through trial and error. Before you go, don't forget to hit that like button, subscribe, and turn on notifications for our channel so you never miss a financial beat.